SCHD is for most investors the best dividend choice out there, but it's not enough. It's a wonderful ETF with great long-term performance, high and stable dividend yield, but what I'm going to show you today is a combination of SCHD with another ETF that perfectly complements it, making this two funds portfolio almost invincible. To find this combination, I've analyzed over 30 major ETFs and found out which one better complements SCHD based on low holding overlap, low industry overlap, high long-term performance, as well as fundamental metrics and fees. And why would you want something like this? Well, because if you can have two low-cost ETFs that make all the work for you and cover all the bases, you can call it a day and go back to Netflix or meet with your friends and tell them why you're going to retire at 45, and they aren't. Now, some of you might think that SCHD alone is already a perfect package, because I know there's a lot of SCHD fan out there. But today I'm going to explain why SCHD does have some flaws and why the second ETF of the portfolio is going to compensate for them. And also why this combination might actually be better than buying the glorious S&P 500, which alone is considered by many to be the perfect portfolio. If you don't know SCHD, this ETF tracks the Dow Jones US Dividend 100 Index, selecting 100 US securities with at least 10 consecutive years of dividend payments. The index excludes REITs, and the screens are free cash flow to total debt, return on equity, indicated dividend yield, and 5-year dividend growth. SCHD is so good that it almost outperformed the S&P 500 since inception in 2011, if tech stocks didn't gain as much as they did in the past few months. Even backtesting SCHD's index to 1999, like they did at seekingalpha.com, you'd see that SCHD, had it launched earlier, would have succeeded to the S&P 500 during periods of market stress, like the tech crash in the early 2000s and the great financial crisis in 2008. Add this to a 0.06% expense ratio, a solid 3.67% dividend yield, and a stable dividend growth, and you see why SCHD is so loved by all investors. Nevertheless, SCHD does have two major issues, and they are diversification and growth. With its 100 holdings, SCHD has a total weight of 90.96% in the top 25 industries, against 65.29% of the S&P 500 ETF SPY. Of course, having only 100 holdings and focusing on a narrow number of industries, if well done, is a great way to concentrate on the top performers. But most investors want to diversify more and cover other well-performing sectors that are not covered in SCHD. This brings us to the second issue, which is the lack of growth. SCHD is fundamentally a dividend value ETF, so it doesn't cover growth sectors so much like technology, which is only covered with 12.50%. To compensate for these issues, I propose to you a combination of SCHD with another Schwab ETF, which is SCHD, the Schwab US Large Cap Growth ETF. And I'll show you how this strategy can actually win against the S&P 500. SCHD is another low-cost, broad-based, well-diversified ETF from Schwab that covers the large-cap growth sector. It has a lower expense ratio than SCHD with just 0.04%. Founded in 2009, 2 years before SCHD, it has over 19 billions in assets under management with a total of 255 holdings in the large-cap growth sector. The annualized returns since inception have been an astounding 14.58% with 31.47% year to date. And the main holdings are great growth companies like Apple, Microsoft, Amazon, and Nvidia. The greatest advantage of this two-fund ETF strategy is that it's very easy to overweight or underweight a particular factor compared to just only the S&P 500, because you have value and growth separated. For example, if you're confident in value stocks for 1 year, buy SCHD. Or if you think growth is going to outperform, buy more SCHD. Either way, you're investing efficiently because the two ETFs have almost no overlap. This is a table that I created that shows the overlap between SCHD and other famous ETFs, and you can see that SCHD with 4% has lower overlap with SCHD than most other growth ETFs like VUG, VGT, or even the well-loved Invesco QQQ Trust ETF. By using the ETF research center etfrc.com, you can calculate the overlap between two ETFs. And with SCHD and SCHG, you can find this 4% that I mentioned, which comes down to just 4 holdings: Broadcom, BlackRock, EOG, and Coterra. The reason for the low overlap is because of a difference in screening criteria. SCHD tracks the Dow Jones US Large Cap Growth Total Stock Market Index, weighting stocks by float-adjusted market capitalization, and selections are based on factors including forward price-earning ratio, estimated 3 to 5 years operated earning growth, trailing price-book ratio, indicated dividend yield, trailing 5 years revenue growth, and trailing 21Q EPS growth. On the other hand, SCHD tracks the Dow Jones US Dividend 100 Index, selecting 100 US securities, excluding REITs, that have paid a dividend for 10 consecutive years according to 4 criteria: free cash flow to total debt, return on equity, indicated dividend yield, and average 5 years dividend growth rate. In short, SCHD and SCHD have almost no overlap because the screens have virtually no overlap. That's why they complement each other so well. Nevertheless, let's see how a portfolio of the two in various allocations would have performed since SCHD launched in October 2011. The best performance would have been achieved with a 60-40% portfolio with 60% SCHD and 40% SCHD, with an annualized return of 15.17%. Obviously, this is due to the overweight in the technology sector, but it's interesting to see that also a 50-50 allocation would have performed over 1% better than the S&P 500. The following table highlights fundamental metrics for SCHD's top 25 companies, which total around 72% of the fund. If you focus on the sum, you can see that SCHD is a highly concentrated portfolio compared to SPY, which is the S&P 500. But it's not such a big deal because we are combining it with SCHD. As expected, SCHD has a better 5 years historical revenue growth, 16.97% versus 11.25%, 1 year estimated sales growth, 11.89% versus 8.50%, and 1 year estimated EPS growth, 12.17% versus 8.78%. Most top holdings pay low or no dividends, so you're gonna get around 0.50% dividend yield. But again, you're not buying SCHD for the dividend yield. SCHD has a 9.58 out of 10 profitability score calculated from Seeking Alpha, which is higher than SPY. Probably the most important negative point of SCHD is the high 34.88x multiple for forward earning valuation, which shows how expensive the ETF is compared to the earnings. This is mostly due to the high concentration on overvalued tech stocks, and of course makes us wonder if maybe other growth ETFs like VUG or QQQ might be better suited for a combination with SCHD. In particular, QQQ has been the best performing growth ETF since 2010, but we'll see in a couple of minutes why I don't believe that QQQ is actually a better option here. Now imagine investing 50% in SCHD and 50% in SCHG. You'd get pretty much this distribution. The allocations are almost identical to the S&P 500, with the most significant differences being a slight overweight of industrial, healthcare, and energy compared to it. On the other hand, the 50-50 portfolio underweights utilities, real estate, and financials. This table instead shows you the fundamentals if you invest 50-50, 60-40, and 40-60 in SCHD and SCHG compared to SPY. If you look at the 50-50 portfolio compared to the S&P 500 with SPY, you see that it reveals a lot of similarities. The 50-50 portfolio has 16% more concentration on its top 25 holdings, 0.55% better historical revenue growth, but 0.40% lower estimated growth, higher dividend yield, and better historical dividend growth. It's hard to say for sure if a 50-50 portfolio of SCHG and SCHD is better than S&P 500, but for those of you who invest in SCHD, it's definitely a better solution than trying to diversify SCHD with the S&P 500. Now, I mentioned before that the Invesco QQQ Trust Series 1, ticker QQQ, has been the top performing large cap growth ETF since 2010. So what happens if we substitute SCHD with QQQ? One good thing is that the 5-year annualized return increases from 13.31% to 14.30%. But this is probably the only good thing. The portfolio gets less diversified, with 65% of assets in the top 25, and historical and estimated growth rates declined. When you compare ETF, or you try to find combinations like we did today, it's easy to rely solely on back-tested results and see that if you pair QQQ with any value ETF like SCHD, you can improve returns a lot. However, performances are not a guarantee of future returns, so you always gotta try to see all the other fundamentals of the ETF. I'd love to hear what you think about this combination SCHD, SCHG. So let us know in the comment section below, and don't forget to subscribe to the channel for future videos like this. I wish you a great day, everyone. Thank you so much for watching till the end, and as always, I'll see you in the next video. Ciao!